Hey everybody, Andy Moss here, tradingadventures.com with a look at your weekly charts here on Saturday. First thing we notice on the S&P 500 is that this is another week of steady, sustained selling. We've now got 5 red candles in a row. Each one of them, each of the last 4, closing at or very near the lows of the week. Bounces have been getting smaller, or I shouldn't even say bounces. The slight excursions higher have been decreasing in size, and with just people getting out of the way. So here's the SPY. Same information. We're below the anchored VWAP from the tariff tantrum, the April 2025 dip. And notice that we're not quite yet oversold on RSI. And once again, just to recap, we started tracking this back in fall of last year. As the index was rising, we started paying attention to this Fibonacci extension level, and we noticed repeated attempts to get above that, which could not sustain. And then a little bit of indecision. And now we've got 5 weeks of selling as we see the events and news unfold in the Middle East and other places. So flipping the cues, similar situation here, well below this anchor off the April 5th lows, or the April 2025 lows. And the selling took a little bit of a break in here. Got started a little sooner, took a little bit of a break and some consolidation. And now 2 really big weeks of, again, this is just people positioning more defensively and getting out of the way. Dow 30 stocks back down to the level we first saw in December of 2024. So at this point, they have erased about the last 8 or 9 months of gains and back into this area, below all of the recent anchors, below all of the moving averages and RSI, still not oversold. So it's a little extended away from the shorter term moving averages, but not washed out yet by the relative strength index. And IWM doing a little better, holding the rising 40-week moving average here. A little bit of an inside week. It did get a move up to this anchor off of the November dip. So if there was a little bit of a bounce attempt or any buying at all, it showed up in the small caps. And notice the RSI pointing back higher a little bit here, trying to see if it can fight its way back up to this 50% level. Volume has been very high, or higher than average, for each of these down weeks recently. And the small caps trying to hold up there, but still plenty of work to do, even though they did hold this rising 40-week moving average. Bitcoin still looks terrible. This bit of a pop back here got shut down at the roughly the year-to-date anchored VWAP and the sharply declining 10-week moving average, and looks to be headed lower once again. And while that goes on, we see the dollar consolidating for the 3rd week in a row in this bit of a range right here around 100. It's still probing and testing this anchored VWAP from the January 25 highs, and more sideways action there for the dollar. We'll shift to volatility for a second here. And as I mentioned on the S&P, where this isn't panic. It's not capitulation. It's not a crash or a washout. This steady, continuous price action tells me that this is much more controlled and even systematic. And again, that lends to the story of asset managers, portfolio managers, people positioning their investments just in a more defensive way, which we've noted for many weeks in a row now, first showing up in things like the staples and the utilities and that kind of stuff, energy. But the indices were kind of the last to fall. But now we're seeing money come out of the market, out of the equity market on a more of a wholesale basis there. And if we add to that, this is not a large, pronounced spike in volatility from a low level. This has been building slowly since really the beginning of the year and coming up, and a little bit of a jump here 3 weeks ago, but not a big one-time event. like these over there. So that's another piece of the puzzle suggesting that this is more controlled, systematic selling and rotation than it is a shock or a panic kind of move. So moving into the overseas markets, we see the ACWX still holding this rising 40-week moving average here, still holding this anchor off of the April 2025 lows. China is sliding further. Not really much in the way of potential support. Hasn't been any realized support so far, and still dipping lower, and no horizontal price memory really comes into the low 30s. We do have a DeMark buy set up here, which again, that's context. That's not a signal, but it is just a condition showing that selling has been steady, and maybe it starts to slow a little bit in here, but that will remain to be seen. RSI 34 or 33.95, so not yet oversold on that. And once again, something we've been watching for months now is this negative divergence in RSI. It kept getting lower and lower as we're getting higher, indicating that we should be of a bit of a cautionary outlook, and that's what's playing out here. So the bond market continues to be weaker. Very high volume this week on the AGG, TLT Treasury bonds also weak, down below all of these areas now, and looking like they want to head below 85 and potentially test this area of recent price memory over the last year or two. High yield, you guessed it, still trading like stocks. That's what high yield bonds do, and really intense selling. We had this big gap down several weeks ago at the outset of the Iran news, and now it's just been continuous downward action on very high volume for the last 4 or 5 weeks in a row. Moving into the commodity space, this continues to hold up very well. Of course, I always point out this GSG is a very oil heavy index, so no surprise that we see it holding up here and doing very well, holding new highs, actually expanding the range here after a couple of weeks of maybe some slight contraction, but the 4 week, the 10 week, the 40-week moving averages all rising very steeply. The RSI is incredibly overbought up here at 85. And that doesn't mean it has to come down. It just means the price action has been very, very strong. Crude on its own, still working in and consolidating this massive range we saw 3 weeks ago. Much bigger range this week as it dipped, and that's the headlines that look there. If you think about the timeline of the news, maybe we have a ceasefire, maybe we have a resolution, maybe we don't. Oil goes down, oil goes back up. It's all very event driven at this point. Gold came down, touched its rising 40-week, and now with a hammer-ish candle here on gold as it comes back up into this anchor from this little bit of a dip back here in November. So not unusual considering the massive rise it had up here to nearly 5,600, back down to 4,100, and some more consolidation in this area should not be unexpected. Silver, not quite as pronounced of a bounce and didn't get down to its 40-week, but still a bounce there. It did touch this. This is the 20-week or the 20 period moving average here is the center of the Bollinger Bands as they start to come back together a little bit. RSI holding the 50% level so far. So it looks like silver may be trying to gather itself, and like gold, it may consolidate in and around this area a bit further, or it could go down and touch the 40-week. We'll have to see how that one shapes out. And moving into the relative strength indices, we've got growth versus value here, and we see once again, this is something we've been tracking repeatedly. We had this first little trip lower on the RSI, and I've mentioned many times that this seems to be the pattern lately has been, or for several years now, has been that the first trip lower on RSI does not mark the ultimate low. It very often gets exceeded, and then we can start to look for a more meaningful bottom in this relationship. So maybe that happens again. It looks like it's starting to now, as we saw the action, a little bit of a bounce here 4 and 5 weeks ago, 3 and 4 weeks ago, and now making new recent lows, new lows for the year. And once this, if the pattern is any indication, it has been before, maybe it will be again. We don't know that for sure. But if RSI were to go down and make a new low here, then the recent and history would suggest that maybe as price gets down in this area and RSI gets even further washed out, then we may want to consider looking for a more meaningful low in that relationship, and we could possibly see a shift back towards more growth-oriented sectors and away from value consumer discretionary versus consumer staples. Several weeks in consolidation here. This is a bearish consolidation pattern below all the moving averages with RSI in the lower half, and that tells us to continue to be on the lookout for a move further down in the favor of the staples sector and away from the discretionary. High beta versus low volatility. A little bit of a bounce over the last couple of weeks. Briefly up above the declining 10-week moving average and now back down here. So no major development there, but we did see resumption of back in favor towards the low volatility allocations of that. And that's pretty much it for our relative strength measures. Now let's look at some of the individual sectors. Here's the semiconductors. This has been one of the last holdouts of strength in the market, and even it is showing increased selling pressure here now. So if that gives way, that may be the final straw to take the market down to a point where we might start to think about seeing a local low or a spot for maybe a reactionary bounce. Doesn't mean it would be the low, but we can keep that in mind. Biotechs rolling over continue to look like a bit of a rounding top and breaking down below this level. And there's a lot of space down here from this weekly close to the rising 40-week moving average. So those look pretty suspect now. Software, that bounce was short-lived and not surprising to see it come all the way back down to nearly below over here a couple of weeks ago. Volume remains very high. The Bollinger Bands remain very wide, and expanding RSI is very weak. And then the Mag 7 as a whole, we see it just really accelerating down through this level of this top back in December of 24. And just nothing great to see there right now. I'm going to show you one more chart real quick, and then I got to wrap this up for the morning. Bear with me just a minute. Here is the percentage of S&P 500 stocks above a 50 and 200 day. And interestingly, somewhat a little bit of a moderation here on the percentage above a 50-day moving average as the price comes down. So not yet to washed out levels. We want to see that really down below this 15% area before we can start thinking about maybe some potential for that reactionary bounce. Of course, that can show up at any time. This doesn't mean anything has to happen according to this chart. Just context that we've seen previously that has led to a durable bottom or a reactionary bounce. So that's it for this look at the weekly charts. I'll round it out on the roadmap, the 1 hour chart of the stock index futures. We can see that continuous sequence of lower lows and lower highs below declining 5-day moving average. Nothing to get excited about here from the long side. So the story remains the same. We're going to go slow, take it easy, be patient. There's not a lot of good swing trades set up for long positions these days, and shorts continue to be difficult. It could get even more difficult as we get more extended to the downside. And any bit of good news that comes out of the blue could create some massive rallies that would make shorting very difficult as well. So we're just going to take it easy and go slow and watch the charts as they develop. Thanks for taking a look. You can catch all of these on my website, trading-adventures.com, and on X, Andy__.